Welcome to The Explainer. And today, we're not just talking about some new app or a cool new way to pay for stuff. No, we are going way deeper. We're going to break down how money itself is getting a fundamental software upgrade. Think about it. Moving from this old, clunky analog system into something truly digital, something that's actually built for the internet. Okay, let's just dive right in with a simple question. I mean, our entire lives, the entire modern economy, it all runs on the internet, right? And the internet never sleeps. So why does our money, why are we still stuck with settlement delays, bank holidays, and annoying cutoff times? That's the core question, and it's exactly what this new form of digital currency is designed to fix. And look, this isn't some science fiction idea about the future. We're talking about a market that's already here, and it is huge. By 2025, it's already worth almost $300 billion. Yeah, stablecoins have gone from this kind of niche crypto thing to a major part of global finance, and the growth, it's just incredibly fast. So who's driving all this growth? Well, it's the biggest names you can possibly imagine. We're talking Visa, MasterCard, PayPal, Stripe. And they are not just playing around or dipping their toes in. No, they are actively wiring this tech into the very core of their global payment networks. This is happening right now, as we speak. Okay, so what happened? I mean, how did we get from what felt like a Wild West experiment to something that Visa and MasterCard are totally comfortable using? Well, it all comes down to a new global rulebook. Over the last year or so, governments all over the world finally got on the same page and created clear, predictable rules. And what's really fascinating here is just how fast this all came together. I mean, look at this timeline. In just over a year, you've got the EU, Hong Kong, and the United States all landing on incredibly similar rules. It's like a switch flipped. And that rapid agreement, that's what created the stable foundation for this to become a truly global market. So what did these new laws actually create? Well, they defined a very specific type of asset, what they call a payment stablecoin. The best way to think about it is like a regulated digital twin of a dollar or a euro. For every single one of these digital tokens out there, there's a real dollar or a real euro or something super safe like a government bond sitting in a supervised bank. It's all about being backed one-to-one. The whole thing is built from the ground up for safety and stability. Okay, now this is probably the single most important rule to get from this whole new playbook. To make it absolutely clear that these things are for payments, not for saving like a bank account, regulators in both the US and the EU made a crucial decision. They said payment stablecoins are prohibited by law from paying you interest. And this right here, this is the great compromise that regulators came up with. It's brilliant, really. They created two totally separate lanes. In one lane, you have the payment stablecoins we've been talking about. They're for transactions, no yield, regulated like a payment system. Simple. But in the other lane, for people who do want to earn a return, you have something different. Tokenized cash funds. Think of things like BlackRock's PYDL fund. These are regulated as securities, and their whole job is to pass the interest they earn from things like T-bills right on to you. All right, so the rules are set. The foundation is there. But this is where it gets really interesting and practical. Let's look at how these new digital dollars are actually being used right now to completely change the game in commerce. So who are the earliest and biggest adopters? The major card networks. For them, stablecoins are this incredible tool to fix really old problems. Imagine being able to move massive amounts of money between international partners instantly, 24/7. No more waiting for banks to open on one day morning. It closes those weekend liquidity gaps and just makes their entire network run so much more efficiently. And the uses just explode from there. I mean, we're seeing them for everything. Instant business-to-business payments across borders, cheaper and faster ways for people to send money home to their families. Even huge retailers like Walmart are looking at this as a way to cut down on those annoying credit card fees. And it gets even more amazing. Organizations like the UNHCR are using them to get humanitarian aid directly into the hands of people who need it in some of the most difficult places in the world. Okay, so we get the tech, we see the real-world uses, but now we need to zoom out because the implications here are way, way bigger than just faster payments. What we're really seeing is the start of a new, high-stakes geopolitical game. See, the vast majority of these new regulated stablecoins, they're pegged to the US dollar. And this is creating something people are calling dollarization 2.0. Think about it. It gives anyone in the world with an internet connection the ability to hold, save, and spend a digital version of the dollar.
This massively extends the dollar's influence right into the heart of the new digital economy.
And as you can imagine, the rest of the world has definitely noticed. The major economic powers are all responding, but with their own very different strategies. You can really see a spectrum of control emerging, from very hands-off to completely state-controlled. Everybody is racing to define the future of money because nobody wants to get left behind. It's like a giant chessboard, and each region is playing a totally different game. The US is betting on the private sector, using these regulated stablecoins to strengthen the dollar's #1 spot. The EU, on the other hand, is building its own public digital euro to protect its own currency, to defend its monetary sovereignty. And then you have China, pushing its state-controlled ECNY to expand its influence and, crucially, maintain control over financial data. Okay, I know this all might sound super high level, all this geopolitical talk, but these big shifts we've been discussing, they have real, practical meaning for you, for me, for small businesses. So let's bring it right back down to earth and break it down into a simple playbook. It really just boils down to using the right tool for the right job. Simple as that. If you're just spending money or sending it to someone, a regulated payment stablecoin is probably going to be cheaper and faster. But if your goal is to earn a return on your cash, then you look to those regulated tokenized funds we talked about. And hey, if you run a small business, accepting stablecoins can mean way lower fees and getting paid instantly, instead of waiting days for the money to clear. That's a huge deal. And that leaves us with one final big question. This technology, it's basically a parallel financial system, one that's faster, cheaper, and never, ever sleeps. So is this the thing that finally disrupts traditional banking as we know it? Or is this the moment the banking system saves itself by adopting these new rails, by upgrading its own ancient plumbing to stay relevant for the next 100 years? The game is definitely on.